All right, so talk to me about the jobs report. What's
Well,
going
this
on?
is one of these famous, semi-famous situations where good news is bad news, and this was an interesting one because it way blew the numbers out of the water. It was much higher than anticipated. So the numbers were the estimates were 187,000 pay. We're going to add that many jobs in the month, but it was 517,000, and the unemployment rate fell to 3.4%, which is the lowest of May
Whoa.
1969. So that's pretty significant. All that we've talked before about the tech headlines of the layoffs, and all those are big numbers, right? I mean, Microsoft, Google lays off, into the five figures. But other than that, the jobs numbers have been pretty good. So you would think the market would cheer that and be excited and say, well, that's good. The economy's running. But one of the things that the Federal Reserve is trying to do in a way is to slow the economy down a little bit, because it gets ahead of itself and then it can cause inflation. So they've been laser focused on trying to solve the inflation problem. And you solve that in theory by raising rates and slowing the economy down a little bit. So a really good jobs number can be inflationary because it pushes wages up because there's more demand, because there's fewer workers out there and is the available pool. So now the thing is, well, now the Federal Reserve is going to raise rates a little bit more because the economy is running a little bit too hot, and higher rates are typically bad for stocks. So the market did go down Friday after the news. So it's an interesting time because it's the good news is bad, and sometimes bad news is good as it relates back to what the market's doing and what the Fed's doing.
Wow. So the man just can't stop keeping us down, huh? So
Yeah,
it's
it's definitely the
good
man.
news. Unemployment's low. Everybody's employable. Everybody's everybody. I'm using generalization, but the economy added what was it, 500,000 jobs in
Yeah.
the month of
Yep.
January. And then the man's got to say, whoa. Now is the time to raise rates and make things a little more expensive for you to buy.
Yeah, I mean, the idea is that as rates go up, he's actually trying to curb inflation, so trying to slow down inflation. So making it more expensive to borrow for sure, but making it more expensive for companies to borrow, which in turn will slow them down a little bit and slow the inflation numbers. So
Now,
that's supposedly how everything's supposed to work. But
right.
the phrase you hear a lot is soft landing, right? Is he going to be able to slow the inflation number down without completely, throwing us into a deeper recession? So that's the CNBC soundbite that you always get, right? Are we going to have a soft landing? Is Chairman Powell, is he going to be able to orchestrate a soft landing here? So that's the question, right? Can he raise rates the appropriate amount at the appropriate time to slow inflation without really putting a significant headwind on the economy?
What is the current rate from the Fed?
Well, so what they're able to do is they're able to adjust what's considered the short end of the curve. So they can't do anything about the 2-year, 5-year, 10-year. They just affect the overnight rate, and then that kind of spreads through the market. So the overnight rate
Are you still
here.
presenting? Because I'm not showing your screen right now.
Did it leave?
Well, I wasn't sure if you had
Oh,
something to share.
no, I was just going to look up what the
Okay.
Fed overnight rate is. Nathan can cut out this part. Yeah. So the overnight Fed funds rate is 4.58.
Okay. So
And
that's not
that's pretty
zero
significant.
anymore, because it was like near zero for a bunch of years in the teens, right?
Yeah. Yep. So it's been pretty for basically 10 years. It's been almost zero. So
Now, can I ask you a really technical question, which I don't hold, it may be malphrased or not.
yeah.
So the Federal Reserve effectively lends the U.S. government money, right? And then the economy pays back the reserve in interest.
The Federal Reserve would be so they set the overnight lending to banks. So it's the rate that banks are borrowing money overnight to make sure that all the financial systems can everything can run smoothly there. So that's what they're doing there.
The lead I'm trying to lead the line of questioning to is in essence, is it no, I don't want to lead. I don't want to be leading in my question, but is it healthy, in fact, that the Fed's interest rate makes its way back up? Because in essence, if our economy is producing and hot, 500,000 jobs in a month, and now's the time to raise the rates, that opportunity to raise the rates, doesn't that in a way kind of contribute to an even more healthy economy if the Fed is if we're paying back the Fed in how much does this relate to the federal debt or the debt that we always hear about?
Well, it relates. Well, so that's a few different questions rolled into one, but good question. So a healthy economy should be able to support a higher interest rate, right? So you hear phrases like, well, the market got, could even be the housing market, but they got addicted to cheap cash or whatever. So you hear that like fundraising when it's in Silicon Valley or something. It's like, well, geez, if you can borrow money at 0 or 1 or 2% for 10 years, it makes it very easy to make that loan profitable, right? So a higher rate makes people a little bit more conscious of what they're doing and how to if you're buying a house at 0% interest rate, it's maybe an easier thing to afford a much higher house than you normally would be able to afford. So a healthy interest rate for mortgages is probably 5 to 7%, depending on who you'd ask. So you want the market to be able to support you don't want the housing market to continue to fly only because interest rates are very low. You want a healthy, normalized market. So when he's raising rates, he's trying to normalize everything, because you want to have, what you'd say is you want to have some dry powder in case we do go through another major recession, or if there's some sort of cataclysmic event that's outside the area of economics. You want to be able to lower the interest rates to stimulate the economy. But if you're always at 0 or very low interest rates, you don't have anywhere left to go. You don't have that ability to help the market out and help the economy out by lowering rates. So you want to get it normalized, which is where he's getting it back to. So
But I mean, what is the ancillary benefit for when the Fed raises the rates? That is interest earned by the Federal Reserve or the banks for money borrowed, because that's how banking works. You borrow money, but you're going to pay a little bit for the borrowing.
Yeah, so they're
The revenue
setting
source.
yeah, so they're setting that overnight interest rate, and there's a lot of things that are pegged to that overnight interest rate. So the overnight interest rate moves, so that means that the rates that are going to be charged on, let's say, borrowing for 1 month moves, and then 3-month moves, and then so far down the line. So that's why you'll see when there's an adjustment in the overnight rate of what the Fed does, you'll see the short-term interest rates fluctuate a lot more than the longer-term rates. In fact,
Do the banks get healthier when the interest rate goes up?
banks like a higher interest rate because they're making money on a
Their revenue
spread.
goes up, right?
So yeah, so they prefer interest rates to go up a little bit, and you notice that when it's a rising rate environment, bank stocks tend to do a little bit better, because it's easier for them to make. So let's say when interest rates are 0, they don't if they're making, let's say interest rates are 50 basis points and the bank is making 50 basis points on that, the spread makes it look like it's a lot. The percentage of what they're making versus what the rate is 1-to-1. Whereas if the difference is like, let's say 6 to 6.5, they're still making that 50 basis points, but it doesn't look as egregious, let's say, as the 50 to 50. So banks like a little bit higher interest rate, but then they don't want it to go too high so that people stop taking out mortgages.
Right.
The issue right now, what's happening is they're not paying enough on their savings accounts, according to, let's say, that's the opinion of some senators and Congress folks. So they've had to come before do the dog and pony show, come before Congress, and give indications of when they plan to move those interest rates up. Because if they're lending out at 5, 6, 7% and then only paying you 0.5% on your savings account, they're making an awful lot of money on that spread. So so you have some people in the government saying, "Hey, what's going on here? Why haven't you raised the interest
Yeah,
rate?"
I'm pretty sure in my entire life, saving money uh, was never besides the effect of having money. It was saving money was never an important investment vehicle for an individual, right?
Yeah, like the actual savings accounts. Yeah, I mean, for both of our lives, we've been in basically declining interest rate environments for the last 40 years, so we've never really had that. And you and I have never really uh, dealt with an inflationary period either. So you've never had that situation where the cost of goods is going up, meaning that money that you have in your savings account is worth less and less, right? You're able to buy fewer and fewer eggs with that same money that you have in savings.
Didn't we just go through that over the last 8
Yeah.
months?
Yeah. Yeah. Before this, I
Okay,
mean, the last year or so has been the first real inflationary period we've had. So people are looking at that and saying, well, if I put money into savings, I'm just losing money because everything else is going up. So
right.
so a lot of moving parts here,
Huh.
but
There was one more question I wanted to ask you. Oh, last question, with completely left field. Any news uh, on the Fed's exploration of a digital currency?
no, it hasn't really been a hot topic issue. I know. So Fidelity was a major player, obviously, in the 401k space, and there was some Elizabeth Warren was urging them not to get involved in the crypto
Oh,
space.
Elizabeth
Um,
Warren, with her
yeah,
infinite wisdom, she's just great.
yeah, I think it's probably a little bit overblown there. I'm not seeing a lot of demand for it right now. I'm not seeing a lot of plan sponsors, meaning business owners. I'm not seeing them ask for it, and I don't think Fidelity is getting much demand for it. But I think they're just trying to position themselves long term, and everybody else will kind of follow that lead. And I'm sure there's channels, boardrooms having discussions about, different ways to access crypto and 401ks and stuff.
And crypto's certainly cooled right now, and a lot of the bruising is probably hasn't the purple hasn't gone away from the bruising, I think, of the crypto crash, right?
Yeah, I think that's a good way to put it. I mean, it hasn't grabbed the headlines that it was getting, a month or so ago. Although there was an issue with Binance. Was it Binance this week? And
Binance
their
just made a headline, something about they're not taking dollars anymore, or
yeah, they're not converting back to dollars. I think it was so U.S. dollar transfers. So that stuff is always sort of scary. But at least people have had enough time to kind of hopefully prepare and move their stuff to where it needs to be. But
yeah. I Every once in a while I post on social, check on your crypto friends.
yeah, right. Although it's done pretty well the last couple months. Bitcoin, at
What's
least.
Bitcoin doing right now?
Bitcoin right now is
Where are they? 20 is seems to be the benchmark lately.
yeah, and I don't know if it hit 24. It's close to 23 right now.
All right.
Um,
So for the last 6 months, that seems pretty healthy relative.
yeah, yeah. I think we made it as low as 17 or 16.
Cool.
Yeah, definitely in the 16s. But
Well, there you go. That's the jobs report for January. Thanks for covering that. That's I guess that amounts to our finance piece of the show.